All right, ladies and gentlemen, I hope you had a wonderful weekend. It was absolutely wild last week, and we saw the first red week in 5, but then on Friday, that end of the day move was absolutely wicked. But now, coming into this week to start off the second half, we have a bunch of data. It could finally move the market, and one of those pieces of data is going to be the jobs report, and that should be important. So I have everything for you. I got the keys. I have the plays, everything we did on Friday. A question, a good one. We're going to talk about prices, a little bit of a macro thing. I don't know if y'all remember that 2020 video. Let's get rich off info. I might have to make you another one, but I got that. And then we have one of my favorite lessons that I'm going to be going over. So I have all that. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning. And I always usually forget, but today's Sunday. Tomorrow is Monday this time for real, and this is the random account. And what we ask from you on this watch list, you post a random option trade in the comments. Keep it below $100, preferably with time, and then we are going to pick a play in the morning and buy it randomly and see where it takes us. It started off good. I don't know. We need one, man. We need a good one. So, Chad, let's get it. But now, run it, baby.
On the way, another day, it's a blessing. Make a play, either way, it's a lesson. It ain't safe, that's okay, we ain't stressing. Playing my position before I ever play a victim. So let me at it, bro. Spirit on the bend to go. I ain't bound with you.
But right off the bat, like I already told you, it's going to be a big week. The non-farms will be the main event on Friday. You're still going to be getting the JOLTS on Tuesday, ADP on Wednesday, jobless claims, initial jobless claims on Thursday, and then we finalize it with the non-farms on Friday. But here's the deal. Liquidity is still going to be a concern. I have another chart that I'm going to show you after this, but what I'm trying to tell you is that no matter what we get, it still may feel slow. We are fully getting into summer. If there's not a lot of data, even if there is, it's these bigger checkpoints like the SCP on the 12th and other things that should keep it slow. So I'm not expecting anything too dramatic. I think on Friday, and that's why I kind of highlighted how wild it was, this kind of made you feel like something was going to happen. We were dropping, we overshot, we were breaking through levels at one point on Friday. You were down like 1.7 on the NASDAQ. That was a very big day, and then by the end of it, a lot of people were figuring we would bounce. We had a nice little call out on the stream, but even the bounce itself was a lot bigger. So maybe we get something like this, but all in all, the data will be able to give us more info, but we shouldn't really be moving too decisively until we get Powell on the 12th. So that's the first part. The other thing, I want you to see it here, is the expectation for this jobs report. It is expecting to come in between 175 or 150 and 180, and last time was 175, but if you don't recall, last time people thought it was going to be very strong, and then it came in weak. So typically, if we get the bigger surprise on the next meeting, you may get the opposite revision. So I would be on the lookout for that. Otherwise, the bigger factor, I think that's going to have a little bit more impact this time around. It will be the unemployment rate. If the market finds a way to ignore these numbers, or since the range over the last 8 months has been about 150,000 jobs. So it's not like you miss small on these jobs reports. If everyone's wrong, they are really wrong. And that's why you haven't really been getting too shocking of reactions. But all the other factors, even average hourly earnings, participation rate, I think those will be key. But quite simply, that unemployment rate, it's hovering right near 4. And if that goes higher or lower, I think people will start looking towards that. But if you want to get a better point out of all of this, that non-farm number will be important. But this time around, I do think all of the little data sets will be much more important. So we'll see how that plays out. The next thing and next key, or I guess it's on the same chart, this is what I keep talking to you guys about with liquidity. So this is from Bank of America, and it is showing you the breadth level. And how do you calculate that? You take the S&P 500 and compare it to the S&P 500 equal weight. The equal weight gives every member an equal weighting, so therefore 1 or 5 or 7 names can't really distort it too much. And what do you notice? This chart is explaining to you what I've been telling you about. Hey, there's low liquidity, but it doesn't mean that like people don't have money and that there's not money floating around. It's all trapped in an AI pocket. And this is what even Mike Wilson and Bank of America has been talking about here. And you could even see it from 23, even the beginning of our year. Ever since this AI boom has started to take place, you had a broader recovery a little bit towards the end of 23. But, I mean, this is just showing you how lately and ever since then, a lot of that money has moved to AI names. So what you're watching is, and you saw a lot of this last week, these equal-nated and a broader amount of names are going down while a certain select is holding us up. And you should be aware of that by now. But I thought this was a fascinating chart. It's the worst breadth since 2009. We'll see where this takes us, but definitely you got to think about this, and it could lead into the next key because I told you guys this last week. Bro, we are starting second half, and now that second half is starting, all you have to ask yourself is a very simple question. Will the current trends that you've seen stick, or will we see a reversal in some of the leaders? And that could even apply to policy, both governmental, all the way down to what Powell is going to do. But the easy way to understand this, go look at bonds and AI. And this is what I'm saying. Second half, as we get both more earnings, more info on policy, election, and all of that stuff, are we still going to see the bonds sell off? This whole anything but bonds, anything but China, will those trends uphold? That will be the big key. And then finally, AI. You know, AI has been leading. It has been blowing it out of the water with both earnings, anything related. I mean, I guess Intel would be the only one that gave up, but broadly speaking, are we going to watch this AI trend continue to carry us through the second half, or will we watch a little bit of reversal and maybe you watch people start going for value names that are beaten down? Now, nobody knows, but this is the question that you got to be asking yourself, because second half does bring its own set of challenges, and now we're getting ready to close out this year, whether you like it or not, man. I know it's already 6 months in, but that is key number 2. And then finally, I'm saying there's a lot of data, and it's not just the non-farms. You are going to be getting a ton of CPIs, GDPs, even a little bit of ISM data in the States, but a lot of countries overseas, they will be having a lot of data. And last week, even 2 weeks, you have seen both low volume and a lot of news overseas, and some of that inflation news from Germany, Spain, Brazil. We watched some, even the UK, we watched those effects take place last week. So if we aren't going to get any crazy moves, I would still keep your eyes out for this, or maybe some of these days in the morning this week, you may ask yourself, why are we going up? Why are we going down? There may not be much, but if you do get any big data sets or changes that could affect policy internationally, this will be what you got to keep your eyes out for. So going to be watching that. Other than that, though, I think it should be very straightforward. I'm hoping it's a little bit more exciting. If not, I'll be playing 2K by Friday, man. You know what I'm saying? But let us get into the plays. So right off the bat, I got a couple of different plays. I'm starting with one that I'm already holding, and it's CRM, and I think this one should be very important. It's a big name on the Dow. It kind of carried the Dow on Friday. It sold off miserably after that earnings. I bought those 50 shares after earnings at one of the first levels, and then it flushed. I was down a ton on it, but by Friday, it bounced right back up. I'm back to break even on it, but here's the way I'm looking at CRM. It's at that level, a big support level. That's why I bought it the first time. It is either going to hit through that and just keep ripping, and that was the little flush, or it's going to fail here and then go back to 200, and then we may get a little bit more volatility in both the Dow and some of the names that are both had the recovery story, but not really executing like CRM. So going to be watching out for that. That was a very interesting one. That is play number 1. Then play number 2, Caesars. This one was on Friday. There was even a lot of other activists and buying deals. There was even Penn, but Caesar, Carl Icahn, he announced that he has a sizable position, said he is not doing activism, meaning he's not going to try to change the board, get somebody nominated and ask them to do different things. He says he's investing because he liked it, but here's the interesting part about this story. Carl Icahn already sold out of Caesars not too long ago. He had a similar play when it was at the bottom there, and now he is coming back into it. So that should make you ask a couple of questions. I like it. I don't have any plays on it, but I will definitely be watching this into next week, especially if we get more momentum. And I think Sunday, or today or tomorrow, we will be getting some Macau numbers or some of that not Vegas, but Macau, China's Vegas numbers. We just had Vegas a couple of days ago. So we'll see if that factors into anything. But that is play number 2. And then finally, don't charge me with the felony, man. I know y'all will vote, man. If I know some of y'all will. But I'm putting DJT on here. Why? Because all the drama last week, bro. It's kind of wild how many questions I got about this. And then again, I'm sure everybody was talking about it. Even a lot of people were digesting this over the weekend. But quite simply, leave your politics aside. I know you heard this before, whether it was the election, the case, this or that. Everybody is kind of linked DJT to whatever happens to Donald Trump in the political world. So surprisingly on Friday, it did not move that much. So I want to keep this on watch just in case there's any updates, and we'll see if it has any of these reactions we were told it was going to have. So that is play number 3. As far as everything else, I did make a couple of plays on Friday. I covered the pin duo short. There was even more bad news, and then they bounced, so I got $200 off of it. Like I said, I wanted to do it more short term. The news didn't really hit. Again, the first time we played that news, it was really strong. By the 5th, 6th time, not so much, but I think eventually, depending on the right action, pin duo might get clobbered off of that type of headline if we do see the U.S. enforce a little bit more. So watch out for it still, but I'm out of that play. The next play I made on Friday was MNQ. Oh, it was dirty, bro. So I had some great call-outs on Friday in terms of what I expected was going to happen, and then it started coming down. That was part of my plan, and then I bought 2 MNQs, and then it flushed, and I bought 2 more, and then it flushed, and I was down, I think, $1,300 at the low on this, and then by the end of the day in that flip, I sold out at $400. If I held it for another 15 minutes, I think I would have made $1,200 to the upside in total. So it was a wild one, but last week, even then, it was a good set of moves on these micros. We'll see if it could be provided again this week with all the data. Otherwise, that was a play. I don't know if I'll get back into it, but got out of that. And then finally, I grabbed 100 shares of TAP at 54.60. There was news that Sam is going to get a buyout offer from a Japanese liquor maker, and literally all the other sympathies started going up. Somebody asked me, they're like, why would TAP and Budweiser go up? It's kind of like real estate. If Sam, it's a beer asset, if they get a buyout at a premium price and now you get a comp valuing certain assets at a certain valuation, in the short run, it helps the stocks out a little, because then people are like, oh, yeah, then that means ours is worth this because someone just paid that for that, So, yeah, but that was everything. As far as the questions now, I really like this question. I had this one over the weekend. Somebody emailed this one to me as well, and then I actually got into a discussion with this over the weekend. It was actually, I don't know, maybe you could bring this up at the dinner table, but here is the question. Will prices ever come back down again? So I love this, and the answer is yes. Eventually, you will have a short period where we go through deflation. I do think we will have that. I don't know when, whether it's in a year, 10 years, 15. Point is, it's going to happen eventually, and it's not going to be just disinflation. Right now, we want disinflation. Inflation going down, but not as high, versus literally no inflation, strengthening of the currency, but more so a bigger collapse in prices. So this is the weird part about deflation, because everybody wants lower prices, but you don't really want deflation. It's a scary Frankenstein thing, but I was answering this right now, and I talked about this over the weekend, but we got to go back a little bit, man, and you got to really understand what happened here. And the key is that the dollar has been revalued, and moving forward, it's going to happen again. It depends on supply and demand, and then how people's behavior is and how they feel. So I don't know if you remember this video I made in 2020. It was called How to Make Money Off of Inflation. I'm telling you, man, if you watch this video at that moment, finger to the sky, bro. It was very timely, and we talked about what was going on. I even brought up, the 2008 bills, and we have to think about 2008 for a little bit, but the point is, during 2020, the dollar got revalued. There was a huge supply increase over the last several years, but ever since 2020, you started seeing dollars becoming more easier to acquire. Quite simply, the dollar became less scarce, and that led to people revaluing it. That's why, not really much has changed, but the same item, you're paying a lot of money for it, is because of the scarcity and then how people behaved, and that essentially revalued the dollar and what you get with it. Now, this is what I'm saying to the reverse. We're going to go through a period where it does the opposite for a little bit. It's usually caused by a crisis that causes it, but you will see it where there's all the money in the system, and even though there's printed a lot of dollars, people's behavior might lead them to hoard it. It may become scarce. You're like, oh, that'll never happen. Japan is staring at you right now like, so it's possible, and it depends on people's behavior, and then you will get a temporary revaluation of the dollar until it goes into the next period. But I do think everything that's happened from 2020, you should watch that video. It is all following in line with this, and what sucks about it is you never know when these events in society, it's going to really happen like that, and then the economy is a slow-moving ship. It takes a lot of time. So, yes, I do think prices will come down one day, but I don't know how long it's going to take, and then, therefore, this doesn't mean you don't own assets. If anything, it just means you should mind your leverage and position accordingly, because if there is a big revaluation in the dollar and it changes a lot of things, the people who really struggle are the people who have a lot of leverage, because now if you can't hold it through the revaluation and all that, like think about it. Before you had the inflation of 2020, the 6 months prior, there was deflation. People weren't working and doing a lot of house prices were dropping, and you had that temporary revaluation. And if you are on margin, you have loans, that is what is going to hurt you. So the thing is, and this is where I had my talk on the weekend, I was just explaining how, like, think about it. This is why we have a long-term, even real estate and stuff like that. If there's a big drop in prices, will you get crushed? Yes. But if this is a global thing or United States-wise, and you own assets and everybody gets the same amount of poorer, you owning assets kind of just matches up with that. If everybody loses 30% of your money, your house goes down 30%, but then everybody else is losing in that sense too, you're going to keep your equivalent wealth more or less. The problem would be, though, again, leverage, not being able to hold it, and doing other things that kind of people react to in the situation by choice or by force. So I hope this helps. If anything, you should definitely go watch that old video. But yeah, I think prices will come back down, and the yield curve, give it like, 1 or 2 more months. This will be the longest the yield curve has been inverted since the Great Depression. And when that does finally normalize, I think maybe we will see that, or like I'm saying, maybe the Fed's just waiting for that deflationary cannon before they could cut rates. I don't know. You tell me, but I hope you enjoy that. I've always liked talking about this topic, but now let's get to the lesson, baby. Oh, why is it down there? But this lesson today, I'm not going to do all of it because it's actually pretty long. And honestly, I'm very surprised because we're almost on chapter 4, man. And that's where I was sharing lessons in the beginning, and we were like chopping up the book, So good work, Chad. We've made a lot of progress. I mean, like I'm saying, give me a couple more weeks before we'll be done with this. You got like a decent college education here, and then we're going to be applying it to a lot of other things. But now, today we're going to talk about trade enforcement, but in that it brings up the prisoner's dilemma, and this is always a good one, whether you're in politics or not, finance. I mean, this is a great way to just understand how choices are made, especially when presented with like a winner-loser scenario where you could either gain or lose or have to pay consequences, don't pay consequences, all of that good stuff. So, Chad, I hope you're locked in for it, but now, enforcing agreements. The ability of governments to conclude trade agreements is additionally frustrated by the second intervention of politics, the enforcement problem. The enforcement problem refers to the fact that governments cannot be certain that other governments will comply with the trade agreements that they conclude. As a result, governments will be reluctant to enter into trade agreements even when they recognize that they would benefit from doing so. Even though this might seem counterintuitive, we could use a simple game theory model called the prisoner's dilemma to see how the enforcement problem can frustrate the efforts of governments to conclude mutually beneficial trade agreements. Suppose that the Group of 20 and EU manage to identify an outcome that each prefers to status quo. In the absence of this mechanism to enforce the agreement, would they be able to conclude that agreement? The prisoner's dilemma tells us that they will be unable to do so. In the prisoner's dilemma, the Group of 20 and the EU have 2 strategy choices. Each can open up its markets to other exports, which we will call liberalize, or each can use tariffs to keep the other products out of its domestic market, which we will call protect. Two governments with two strategy choices each generate the 2x2 matrix depicted in 3.5. So if you ever heard Prisoner's Dilemma, this is kind of how it is. It's this little chart here. Again, liberalize, protect, what'd I say? But usually in the traditional one, it's like comply or defect or something like that. So again, it's giving you this in the trade concept or trade context. Man, I'm just saying all sorts of words today, but two governments, 3-5, each cell in this matrix corresponds to a strategy combination, and these strategy combinations produce outcomes. We could describe these outcomes starting in the top left cell and moving clockwise. One word about the notation we use before we proceed: it is conventional to list the strategy choice of the row player, the player who selects its strategy from the rows of the matrix first, and the strategy choice of the column player, the player who selects its strategy from the columns of the matrix second. Thus, the strategy combination referred to as liberalize protect means the row player, which in this case is group of 20, has played the strategy liberalize, and the column player in the EU has played the strategy protect. So we'll make that simpler. So he's saying here, if it's what? He said G20 chose to liberalize. Yeah, so you're starting with this column, liberalize, and then EU goes to protect. So this is the box that we'd end up at. So we can now describe the four outcomes. Liberalize, both eliminate tariffs. Group of 20 exports agricultural products to the EU, and the EU exports manufactured groups to the group of 20, or manufactured goods. But hopefully you guys see this example is the one that we covered the other day on the live stream, the other lesson that we had, because it's talking about this whole, again, the markets that are vulnerable, you protect, the ones you're good at, you liberalize, and this has been the deal with all the G20, European Union, and then it actually went beyond the European Union, but hopefully you're still understanding the context here. But that's option one. The next one, liberalize, protect. So G20 eliminates tariffs, but the EU does not. The EU thus exports goods to the group of 20, but the group of 20 cannot export farm goods to the EU. Protect, both retain tariffs. So protect and then protect. No trade takes place. And then protect, liberalize. So protect, liberalize right here. Yeah, this is situation 4. The EU eliminates tariffs, and the group of 20 does not. The group of 20 exports farm goods to the EU, but the EU cannot export manufactured goods to the group of 20. Now we must determine how each government ranks these four outcomes. How much utility do they realize from each outcome? The group of 20 ranks them in the following order: protect, liberalize, protect, liberalize, protect. Where the greater than sign means is preferred to, it is not hard to justify this ranking. The group of 20 gains the most utility from protect, liberalize. Here, the group of 20 exports to the EU and protects its producers from EU competition. So hopefully that makes sense. They're right here. G20 protects, EU liberalizes. Again, they get to charge tariffs, and then their homies don't. So it makes sense why everybody would want that. The next option, the group of 20 gains less utility from liberalize, then from protect, liberalize. Here, the group of 20 can export to the EU, but must also open its market to EU imports. The group of 20 gains still less utility from protect, then liberalize. Here, the group of 20 protects its domestic market, but cannot export to the EU. Then finally, the group of 20 gains less utility from liberalize, protect, from the protect. Here, the group of 20 opens its markets to the EU, but does not get access to the EU market. In other words, the groups of 20 most preferred outcome is unreciprocated access to the EU market. Its second best outcome is reciprocal tariff reductions, which is in turn better than reciprocal protection. And the group of 20's worst outcome is unilateral tariff reduction. The prisoner's dilemma is a symmetric game. This means the EU faces the exact same situation as the group of 20. Consequently, the EU's playoff order is identical to the group of 20's payoff order. The only difference arises from the notation we use. Like the group of 20, the EU's most preferred outcome is unreciprocated access to other markets, but for the EU, this is the outcome liberalize, protect. Also, like the group of 20, the EU's least preferred outcome is granting the other unreciprocated access to its market, which for EU is the outcome protect, liberalize. Thus, the EU's payoff order is identical to the group of 20 payoff order, but the position of the most and least preferred outcomes are reversed. first. So theirs is liberalize, protect, protect, and protect, liberalize. We can now see how the group of 20 in EU will play this game and what outcome will result. The group of 20 in EU both have a dominant strategy, a single strategy that always returns a higher payoff than all the other strategy choices. Protect is a dominant strategy. Protect dominates liberalize as a strategy because each government will always realize higher utility by playing protect than by playing liberalize. We could see why protect is a dominant strategy by working through the G20's best responses to the EU strategy choice. Suppose the EU plays the strategy liberalize. If the group of 20 plays liberalize in response, the group of 20 receives its second most preferred outcome, liberalize. If the group of 20 plays protect in response, the group of 20 receives its most preferred outcome, protect, liberalize. Thus, if the EU plays liberalize, the group of 20's best response, the strategy that has the highest utility is to protect. Now, suppose the EU plays protect. If the group of 20 responds with liberalize, it receives the least preferred outcome, liberalize, protect. If the group of 20 responds with protect, however, it receives the second less preferred outcome, protect. Thus, if the EU plays protect, the group of 20's best response is to play protect. Protect, therefore, dominates liberalize as a strategy. That is, protect yields more utility for the group of 20 than liberalize, regardless of the strategy that the EU plays. Because the prisoner's dilemma is symmetric, protect is also the EU's dominant strategy. Because both governments have dominant strategies to play protect, the game always yields the same outcome. The group of 20 in EU play protect, and the game ends at protect outcome. Governments in both groups retain tariffs, and no trade occurs. This outcome has two important characteristics. First is the Pareto suboptimal. Pareto optimality is a way to conceptualize social welfare. An outcome is Pareto optimal when no single actor can be made better off without at the same time making another worse off. Pareto suboptimal refers to outcomes in which it is possible for at least one actor to improve its position without any other actor being made worse off. In the prisoner's dilemma, the protect outcome is Pareto suboptimal because both governments realize higher payoffs at liberalize than at protect. Thus, rational behavior on the part of each individual government, each playing its dominant strategy of protect, produces a suboptimal collective outcome. The group of 20 in the EU are both poorer than they would be if they liberalized trade. Second, the protect outcome is a Nash equilibrium. A Nash equilibrium is an outcome at which neither player has an incentive to change strategies unilaterally. If the group of 20 changes its strategy from protect to liberalize, the outcome shifts to liberalize protect, the group of 20's least preferred outcome. Thus, the group of 20 has no incentive to change its strategy unilaterally. If the EU changes its strategy to protect to liberalize, the outcome moves to protect liberalize, the EU's least preferred outcome. Thus, the EU has no incentive to change its strategy unilaterally either. Putting these 2 points together reveals the prisoner's dilemma's central conclusion. Even though the group of 20 and EU would both gain from reciprocal tariffs of reductions, neither has an incentive to reduce tariffs. More broadly, the prisoner's dilemma suggests that even when all countries would clearly benefit from trade liberalization, political dynamics trap governments in a protectionist world. Governments are unable to conclude agreements that make them all better off because each fears getting the sucker payoff. If the group of 20 and the EU agree to liberalize and then the G20 complies with this agreement but the EU does not, the EU has exploited the group of 20. The group of 20 suffers the cost of rising imports without getting the benefit of increased exports. The gains from trade liberalization could be achieved, of course, if governments can enforce international trade agreements. Governments could agree in advance to play strategies if they are confident that cheating would be caught and punished. Moreover, because cheating would be punished, both would comply with the agreement. The international system provides no enforcement mechanism, however. Domestic political systems rely upon the police and the judicial system to enforce laws, but the international system does not have an authoritative and effective judicial system. Instead, the international system is anarchic. That is, it is the political system without an overarching political authority capable of enforcing the rules of the game. Although the prisoner's dilemma is pessimistic about the prospect of international trade cooperation, cooperation in a prisoner's dilemma is not impossible. Cooperation can emerge if three specific conditions are met. First, cooperation can emerge in an iterated prisoner's dilemma, that is, in a game played repeatedly by the same governments. Iteration changes the nature of the reward structure that governments face. In a one-shot play play of the prisoner's dilemma, countries make a one-time choice and receive a one-time payoff. In an iterated game, however, governments make repeated choices and receive a stream of payoffs over time. Assuming that the two other necessary conditions are met, governments will prefer the stream of payments they receive from cooperating over time to the payoff they receive from cheating on an agreement one time. Iterating the game can therefore make it rational for a government to play the liberalized strategy. Second, governments must use reciprocity strategies to enforce the liberalized outcome. Although many reciprocity strategies exist, the most well-known is called tit for tat. A tit for tat, each government plays the strategy that its partner played in the previous round of the game. Trade liberalization by one government in one round of play is met by trade liberalization from another government in the next round. Should one government play protect in one round, that is, cheat on an existing trade agreement, the other government must play protect in the next round of play. Playing such tit-for-tat strategies allow governments to reward each other for cooperation and punish each other for cheating. Finally, governments must care about the payoffs they will receive in future rounds of the game. If governments fully discount future payoffs, the iterated game essentially reverts to a single play of prisoner's dilemma. When it does, the threat of punishment in the next round of play can hardly be expected to promote cooperation in the current round. But if the government care about the future and they use a reciprocity strategy such as tit for tat, then cooperation in an iterated prisoner's dilemma becomes rational. Each government can realize a larger stream of payoffs by cooperating than it can realize by defecting. The WTO provides the first two of these necessary conditions. It helps iterate the game by creating expectations of repeated interaction. Membership in the WTO has been relatively stable. The number of countries that belong to the WTO has increased over time, and very few countries have left the organization after joining. As a consequence, WTO members know that the governments with which they negotiate today will be the governments which they will negotiate with tomorrow, next year, and into the future. In addition, WTO members interact regularly within the organization. Governments have already concluded 8 formal bargaining rounds and are now engaged in the 9th round. In addition to these formal rounds of negotiations, the WTO draws governments together for annual and semi-annual reviews of national trade policies. By bringing the same set of governments together in a regularized pattern of interaction, the WTO iterates intergovernmental trade interactions. The WTO also provides the information that governments need to implement effective reciprocity strategies. Tit-for-tat strategy requires governments to know when their partners are complying with trade agreements and when they are cheating. The WTO makes this easier by collecting and disseminating information on its member trade policies. Moreover, WTO rules provide a clear standard against which government trade policies can be evaluated. The WTO's most favored nation clause, for example, prohibits discriminatory practice except under a set of well-defined exceptions. To give another example, the WTO rules governing domestic safeguards define the conditions that must be met in order for the government to temporarily opt out of its commitments. These detailed rules increase transparency. Transparency means it's easier for governments to determine whether a specific trade measure is adopted by a particular government is or is not consistent with WTO rules. The high-quality information and transparency provided by the WTO allow governments to monitor the behavior of any other WTO members. That is, in turn, make it easier for governments to use reciprocity strategies to enforce the trade agreements. The ability of governments... Oh, wait. No, we're going to end there. I want to go into this, but it's a long chapter. Tomorrow, we will talk about the WTO mechanism, the dispute mechanisms, but I hope you understand the prisoner's dilemma, and it does apply beyond trade. So this is the reason why we're bringing it up here, and this is where he's saying is, yeah, like everybody's faced with this competition, and then it's boiling down to say the WTO allows you to take this one-time game and evolve it and get something where, you know, again, it actually emphasizes and logically makes sense why governments want to trade rather than protect, even though protect at default is more rational. So there's a lot of other things to it, but I think this one is just a simple theory you need to understand. We're going to learn a little bit more about the art of the WTO, and then we're going to start talking about trade politics, exchange rates, currency, all that good stuff. But Chad, that is your watch list, ladies and gentlemen. Make sure Hydrate Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, everything in life, good or bad, is built. Nothing just shows up. It's all built, little by little, baby. So let's build some good things. Hopefully tear down some bad things. But Chad, drink that water, stay hydrated, healthy, all that good stuff. I'll see you in the AM. And we're back. Horn.